Hi, welcome to my channel with Jump for Joy with Michael. So in today's video, I'll be talking about the rental property. What do you need? What's the needed cash flow for the property and how to pay $0 in rental income tax for California. So other states may be a little bit different, so definitely check with your local states and area as well. So in this video, I'll talk about 5 types of deductions you can take on the rental property. And make sure to watch the full video as I'll go over valuable information along the way and provide 3 tips that will help you be successful with your rental properties. I would like to give a shout out to one of my YouTube subscribers, Investing with Kim. I created this video in response to her question. With that, let's go ahead and get started. Number 1 is depreciation. So going into more detail on that, when you purchase the home, right, there's the land value and there's the house value. The land you cannot depreciate because the land is indefinite. So 30 years from now, the land will still be there. So you can only depreciate on the house value. So once you start the rental business, it is counted from that day, 30 years. So you're allowed to depreciate 30 years from the day you start the rental. Number 2 is the interest paid on the mortgage is tax deductible. So if you start with a 30-year mortgage, and I'll show you the amortization chart here, but roughly like the first 9 years of that amortization schedule, you're paying most of that money into interest on the home. So what that means is first 9 years, you're able to deduct more on your taxes because you're paying more on interest. So as each year progresses, you're paying less and less in the form of interest. You're able to deduct less. Number 3 is the annual property tax. So in California, it's roughly around 1.7% tax. Of course, depending on which city or county you live in, they have different tax rates. But roughly in Bay Area and in Sacramento area, it's around 1.7%. Some are even higher. Something to keep in mind, for tax purposes, the house value goes up by 2% every year. So because of that, your tax goes up every year. Number 4, you're able to deduct the expenses on the house, such as the home insurance, if you have a yard maintenance, someone coming by taking care of the grass, trimming the trees, cutting the bush, so you're able to deduct that. Any type of expenses relating to the home, right? So if you have home repairs, things that break down or needs to be replaced, those are all going to be tax deductible. And then number 5 is the travel and meals. So if you're traveling to the house to make repairs, you can deduct the mileage on that. And then if you have lodging, you can deduct those. These need to be related, of course, to the rental business. So if you're showing the home, you're marketing the home, paying for advertising costs, those are all going to be tax deductible as well. And then the learning skills. So if you're picking up more skills relating to the rental, or you're attending seminars, going to trade shows to help with your rental activity or rental business, those are all going to be deductible. I hope you find my video informative so far. If you haven't done so already, please smash the like button and subscribe to my channel. I post weekly content about personal finance. That would really help out my channel a lot. All right, so let's go on to the next section here. So I'm going to go over some examples here with you so you can have a ballpark of how this actually works. So for this example, if the home is worth $400,000 and you put a 20% down payment, I always recommend a 20% down payment because if you pay under 20% of the home value, you have to pay for what they call a PMI, private mortgage insurance, which is anywhere between roughly 1% of the home value, which is unnecessary costs that you'll have to pay. Typical loan, 30 years at a 3.5% interest. The monthly mortgage would be $1,437. So let's go over the first section here is what's the cash flow needed for the home. So in this case, you're going to plug in your mortgage rate. You're going to plug in the property tax rate. You're going to plug in your costs for insurance, yard maintenance, travels, and meals. So I broke it down between month and cost per year. So that total cost is $2,229 for this scenario. So if you're able to rent out the home for $220, that is at a break-even cash flow. So I would recommend having that at a break-even if possible, because then that means all your costs are being covered. You typically don't want to go into a negative cash flow. There are some scenarios you can. For example, if you have multiple rental properties. But I'll go over that a little bit more in a little bit here shortly. How to pay $0 in rental income tax, right? So now let's talk about what I talked in the beginning, which is number one, the depreciation. So if the house is valued at $330,000, excluding the land, you can divide that house value by 30 years. In this case, it would be $11,000 per year or $917 per month. You're including your mortgage interest. So if you're starting off your amortization schedule, the first 9 years is the most interest you'll be paying. So on that schedule, the first year, you'll be paying $11,100 in interest. So per month, that's $925 average. Property tax, $567, and including all of the costs relating to the home. So all that be adding up is $2,633 per month. So that is the amount you can charge in terms of rent to pay $0 in rental income taxes. So if I'm going over the same scenario, let's just say you're renting out the house for $1,229 and this is your deduction amount, you're actually in a negative roughly $400 per month. So you're paying $0 in taxes. And so in this case, I'll go over tip number one, which as you have a negative balance, you can carry that over year. Right? So the next year, if you continue to have negative balance, you'll carry it on to the following year. But let's just say the third year, you have your rental income is exceeding the deduction amount, but now you can start taking away from this balance. So there is an exception around this. If you are a real estate professional, you can actually deduct that negative balance onto your personal income. But to be considered a real estate professional, you have to be spending 51% of your time. So in my case, I have 3 rental properties. I also have a full-time job. So my full-time job is classified as 40 hours per week, which means I spend my time or more on my full-time job. So because that's the case, I'm not able to use the negative balance as part of to reduce my personal income. So for me, I'm carrying on this balance. If I have a balance, I would carry it on year over year. Number 2 to keep in mind is that if your rental income exceeds your deductions, it'll be calculated as part of your personal income tax bracket. So something to keep in mind. You don't typically want that because if you're in a 40% tax bracket, guess what? That difference, you're paying 40% tax on those homes. And tip number 3, So let's say you are having a positive balance, but then there are other houses we have negative balance, right? So if you combine all your homes together and it's a negative balance, that's okay. That's not going to be deducted on your income because at the end of the day, it's calculating all the properties combined. So I hope you like my video and you find that this is very informative. Feel free to comment below if you have some questions. And please like and subscribe to my channel. I post weekly content about personal finance. Thank you. Bye.